However, risks remain for Greece. Using the collective action clauses is likely to trigger payouts on credit default swaps, derivatives used to insure bonds in the event of default. CDS protection has been steadily rising throughout the crisis, but has shot up more dramatically in the past few weeks, as you see at the right of that graph. Joining us for more is Alex Drashevsky. He's founder of Recovery Partners. Good to have you back with us, sir.
Thank you, Howard. It's good to be here.
So what do you think? Does this contain the crisis? Has a disorderly default been avoided?
Well, I think for the time being for Greece, yes. Yes, absolutely. I think they seem to have pulled a bit of a rabbit out of the hat here. But, we only have to look a few months down the road. Samaras of the New Democracy Party looks like he's going to take over as prime minister when the election occurs. And he said he wants to renegotiate everything. Beyond that, we've got Portugal that's on the boil again in the background, and it looks like they might need some new assistance. So I don't think the Eurozone's out of the woods. Another indicator of that is that the in-trade default futures for a member leaving the Eurozone are still trading around 50% for 2014.
Explain those and what they mean.
Well, basically the in-trade futures are bets on a breakup of the Eurozone. It's a contract that basically gauges market sentiment as to how probable that is. They haven't really budged. They're still reading at around 30% probability of a member country leaving the Eurozone in 2012. And even in the face of this news, they're still trading at around 50% probability of somebody leaving by 2014. So how much has really been achieved here? I don't know that much has really been achieved in alleviating market concerns.
So you don't think there's a lower risk of contagion now? Is that what you're saying?
Well, no, I'm saying the market doesn't believe there's a lower risk of contagion. I mean, the contracts are still trading around where they have been for the last couple of weeks. So the market sentiment the stresses haven't been alleviated in the market yet.
So they weren't listening to Mario Draghi yesterday saying confidence is returning to the euro.
Well, yeah. Well, he's talking his book. He's got his big Bertha with the LTRO, and he's sort of basking in some of that glory. But again, it's questionable as to how long the gloss is going to last on that operation.
Now, the German finance minister, Schäuble, has said that there is no chance of another restructuring like Greece. And I'm getting back to your Portugal issue that you raised at the outset. Do you believe that?
Well, I think when Schäuble is talking, he's looking to his domestic political partners, and he's looking at the stresses in Germany, the political stresses that this bailout process has caused. The ruling coalition has lost a lot of support. And, I don't think there's political appetite in Germany to go through this process again. And so that leaves open the possibility of, what happens if Portugal goes down the tube? Are they going to be able to mount another rescue, or are we going to have a disorderly scenario occur then? The Portuguese economy is going to contract between 5 and 6% this year. There's huge problems in that economy. They can't finance themselves in the market, and that's going to be tested.
How do you compare the size of that economy and the size of that bond market with Greece's?
Well, they're around about the same size, but that's really not the issue. The issue is, if Portugal goes, then perhaps Spain, and perhaps we get a renewed pressure on Italy, and so then you get these larger dominoes starting to fall. And I think that's still the issue, and those concerns haven't been alleviated. That's what the market's saying. That's what the in-trade contracts are saying. And so while this is an enormous accomplishment, this is the largest bailout ever, sovereign restructuring ever. It may end up being a Pyrrhic victory,
Are you surprised, though, that they were able to pull off what they did? I think you're a little surprised.
No, I'm not surprised. I'm bemused. I mean, there's so much effort has been expended on this. They've increased the size of the liability. They've increased everyone's exposure in this process. It's a solution that didn't need to be applied. A lot of blood was spilled over this thing. A lot of political...
But they couldn't get to any solution prior to this.
Well, yeah, but the easier solution would have been to say 2 years ago, we need to default now. We don't need this bailout money. And let the chips fall where they may. Greece needs to exit the euro. We know that's likely going to happen in the next 2-3 years.
So
Still.
what about the credit default swap market that I mentioned in the introduction? If the credit default swaps are triggered on this, does it matter?
I think it does, and I think they should be triggered. I don't think we have any news on that. I think we were expecting news around 1 p.m. London time on that, but I don't think the ISDA Determination Committee has come to a conclusion. But I think they should be triggered because the moment you invoke these tag-along, drag-alongs, the collective action clauses, it basically says there's been a default. You know?
A credit event.
A credit event, yeah. And so you don't want to destroy that market by saying there hasn't been something here. Most of the position squaring on the CDS side with the selling banks, the banks that trade these things on an OTC basis, has probably already occurred. So I don't think there's a huge amount of net exposure out there, and I think they should let this thing go.
All right, we will leave it there, but I'm sure we'll be speaking again. That is Alex Jashevsky, founding partner with Recovery Partners. Up next.